Are you looking to create real estate riches? Are you looking to build and sustain wealth through property investment? Well, if you are, I'm sure you're going to enjoy today's podcast where Aaron Christie-David from Atelier Wealth interviewed me for his Australian property podcast. I thought it was such a good chat. I asked Aaron permission to allow you, the listeners and viewers of the Michael Yardney podcast, to listen to this conversation as well. You see, we were going to talk about something very different, and just the conversation morphed to a conversation about why I'm still working, how I've done things, what I see as the opportunities and risks moving forward. So in my mind, it was a great chat. So I hope you're going to think the same. So I guess welcome once again to the Michael Yardney podcast. You see, my aim is to help investors gain clarity amongst the confusion of the many mixed messages regarding the property market. I'm wanting our listeners to develop financial freedom that they're looking for through strategic advice and smart money management. And I really believe that's what's going to come out of the conversation that you hear when Aaron Christie-David interviews me. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. We've get some really good feedback from people, everyone that's listening and tuning in. Guess that you want to hear more of as well. And a name that often comes up is Mr. Michael Yardney. Mate, you've been around, your name's synonymous with property investing. You look at your podcast, it's consistently ranking right up there in terms of the property podcast, one of the leading podcasts in this space. You look at your blog as well, and the blog is one of the most, I think it's Australia's 50th, one of 50 most influential thought leaders you get ranked as, and your blog's right up there. It's a source of information. Like when I look for information, there's a number of websites, and yours is often one of them, which I go to get a lot of data and analytics from as well, mate. So kudos to you for putting out some fantastic info. And I know a lot of our investors that are technically savvy will look at sources like yourself, SQM, CoreLogic, for example, and really use that as a source of truth rather than trying to dropping headlines for the sake of it. There's some substance that comes out in your research and methodology.
If I could interrupt for a sec, Aaron, thank you so much about that. I think it also shows perspective, and including those other couple of good sites you mentioned. In other words, having been around the block a few times and experienced this. So while others are seeing chaos with all the mixed messages, I can sometimes make some clarity out of them.
Yeah, love it. Love it, listeners. So we're in for a real treat today. Like I've said, Michael Yardney, one, needs no introduction, two, well-known in this space as well. So I'd like to go to kind of best in breed and pick their brains as well. That's exactly what we're going to do. Now, Mike, we had a quick chat beforehand, and I said this with all due respect. A lot of investors are using property as a wealth creation tool to escape the matrix. They want to get out of their day job. They want to get out of the rat race. They want to get off the hamster wheel. And that's what investing kind of dangles that carrot for the strategic and well planned out investor. And I certainly see that where you can build a passive income, replace your day job as well. But you got to look at yourself and go, mate, you're showing up. Like we reached out the other day, had a chat, and I was like, mate, you're not showing any signs of slowing down. And it's like, hang on, is property still driving you? What gets you going? Because I'm intrigued.
Okay, so thank you. I'm 72. I started investing in my early 20s, so I've built a very substantial property portfolio. So some people ask, is this guy even real? And I do have a property portfolio of commercial, industrial, residential properties, development sites in a number of states, blocks of apartments, houses, units. So I've diversified and I've got them in the right structures. So I actually have got a cash machine from my property portfolio. Yeah. Sure, I also have the Metropole property business, but I've stepped back from the day-to-day running of the business, Aaron. So I've just been on a 5-week vacation at Christmas time. We're planning our next one, a barge trip. We've already booked it in France. I've got a very balanced life, not day by day. So there's days like today that I'm working all from early in the morning till late at night, putting podcasts together, speaking to experts like you. doing things. But every Tuesday afternoon, there's a spot in my diary to visit my grandkids from my daughter Lisa. Every Wednesday, there's a spot in my diary that's immovable to visit Amanda's kids. Bryce, one of my sons, has had a baby. I see him every week. So I've actually got the choices and balance, but I'm having fun. I'm talking property. I'm meeting nice people. I'm still putting seminars, wealth retreat together and the podcasts. So I'm living off my property portfolio, but I'm doing what I enjoy doing. Otherwise, I think that's why I've been successful. I mean, last year, Pam and I went and saw Paul McCartney. Wow. He's 80. We flew up to Brisbane specifically to see him. I don't think he's got any unmet financial needs, that he's still at his age standing on stage for 3 hours at a time. Yeah. But it gives me confidence that maybe in 8 years' time, I'll still be able to stand on the stage and entertain people and educate people.
I love the ethos. Look, I've got a saying, and I say this to my team and all the clients as well, which is you can't be what you can't see. So if you want someone that retirement weaved into, doing something that you love, which is being an example to your family and your grandkids, for example, yet property forms one part of your asset pool, not overly reliant on it as well. I think you kind of tick a lot of boxes there. I look to people like yourself as inspiration going, just because you've made it now doesn't mean you can't help pass the baton on and help others as well. I think there's an abundance mindset that comes along with that as well. I think there's a willingness to go, I'm still sitting on like 50 years worth of investing knowledge. And, I look at it going, you're progressive, because you're doing podcasts now, like they probably weren't a thing 10 years ago. Blogs, you've consistently just kept that. And success to me is being able to sustain that. And, you apply that type of principle across to property investing. There's people that, probably in business, property, fitness, whatever aspect of life, they start out gung-ho, and somewhere along the line, they lose that momentum, they lose the drive, they lose the focus and the discipline. And life is a very long game. I've got two small girls, mate, 4 and 6, and I'm trying to teach them, at this age to understand that life's a long game, delayed gratification, all the parts that come along with it, but they can't be what they can't see. So we need to model those attributes. We need to model that mindset ourselves instead of telling them.
I think that's a really important factor. So your models, most of our models, the first 9, 10 years of your life are your parents. The apple doesn't fall far from the tree. I did not learn good financial disciplines from my parents. My father every Saturday morning used to sit drinking his black coffee and smoking a cigarette and making notes. And I asked him what he's doing, and he was dreaming what he'd buy if he won the lottery that night. That was his way out of it. I had my parents' friends who were wealthy and owned real estate. They were my friends' parents. And so find models of people you'd like to emulate, see how they think. I still have business mentors today. I still have models. I'm still part of mastermind groups because I want to keep growing. So hang around the right people as well.
I love it. And that's something you just take out of today's chat. Like, I think mission accomplished, where you go, you can't be what you can't see. So find good examples, people that have forged the path, but also we're a student for life. So the fact that you're tuning in, listen to multiple podcasts, and all that our listeners do as well, just feeding yourself with good content, and then the quality of people that you surround yourself with will often dictate and determine your success, mate. So
definitely,
I appreciate that. The sentiment for today's chat is looking at the 2025 property market, and following on from the blog that you released, which caught my attention, which is the 5 property predictions for 2025 that most experts will get wrong. Now, it's kind of a bit of an irony when you go experts and wrong in the same sentence, because you go, how on earth can you be called an expert? A bit like a weather person that consistently gets it wrong and still has a day job. But I'm very curious to go where, for people who haven't read the blog, we'll include the article as well. But when you're getting your crystal ball out for 2025, what inspired you to go, this is what people will get wrong this year?
Because most predictions are wrong, Aaron. So that's my first prediction, and that one's going to be right. I'm sure it's going to be correct. As you said, economic experts, property experts get it wrong. Despite being armed with all the research in today's information age, and despite AI, the problem is the fundamentals: population growth, supply and demand, employment levels, interest rates, the ability to check those things. They're easy to monitor. One overriding factor that most experts have real difficulty quantifying is investor sentiment. And the year started off with still reasonably low investor sentiment compared to 12 months ago when everyone at the beginning of last year, 2024, thought, hey, interest rates are going to fall this year.
Yeah.
And therefore, there was a little bit of a FOMO at the beginning of the year. Remember that? And it didn't come to fruition, just like those other predictions didn't. So I know that you in finance strategically plan for your clients as we do in property. So I think predicting rain doesn't count, but building an ark does. I know it's a well-worn phrase, but it does help with our financial forecasting. So because if we know that most predictions aren't going to be right, like the mortgage rate cliff and the unemployment cliff and the fiscal cliff and all those others, what we like to do is set up our clients with flexibility because we know that we don't know what's going to come ahead. And similarly with finance, we like the idea of buying time, not just properties, to ride the ups and downs. Yeah. So I think it's important. You used the weather analogy a short while ago for investors to prepare not just for the sunny forecast, but for the storms that may be coming their way as well, Aaron.
Yeah, cool. Thanks very much. So if you touched on those little, the micro and macroeconomic parts that really are driving this year's economy. So let's just go through this. So you've got supply, and you've got some thoughts around that. The demand.
Well, supply and demand. So at the moment, we are just not building enough properties, and we know that last year close to 600,000 people came in. Now, we also know that it's an election year, so both sides of Parliament are saying we're going to lower immigration, but not a lot. And we need the immigration. Australia's economy is built on, I think, probably four things. We dig things out of the ground and we sell them overseas, our minerals, and that's in a little bit of jeopardy at the moment with tariffs. We grow things in the ground and we sell them, and that's actually food for Asia. Tourism is a huge economic driver of Australia as well. That's starting to pick up, and education is the other one. It is an export industry. People from overseas are putting money into our country with it. All of those actually need people, especially the education side and also the tourism side, and we need more workers as baby boomers are retiring. So I can't see our population growth slowing. Immigration may slow just a little bit for a short while. There's just not enough new supply. Any new supply coming out of the ground, Aaron, is much more expensive. So you're right. They're long-term factors that we have to take into account when we look at what's ahead for this year.
Yeah, nice. So then we you got supply, demand, immigration. Let's talk about vacancy. And
vacancies are at historic lows now. At the end of last year, skyrocketing rental growth slowed down. Remember at the end of last year, this is the end of rental growth came out some people. This is now unaffordable. Well, January showed, and I haven't seen the February figures yet, but they've shown that rental growth has started again and vacancy rates have fallen. And I know at Metropole we manage properties in Melbourne, Sydney, Brisbane. We've never had as low a vacancy rate amongst our properties, and we look after $2 billion worth of assets for clients. Yeah, nice. There's about 0.5% vacancy rate. We're putting up rents still, and people are paying them because they're good properties. So that's not going to change. Some people rent, a lot of people rent, Aaron, not because they don't want to buy or can't afford, not because they can't afford to buy, but it's because of the stage of their life. They don't want to buy just yet. So investors should provide accommodation for those sort of people, because your future income is going to be dependent on your tenant being able to pay more and pay higher rents over the long term. And that's why I recommend avoiding the cheaper areas where a lot of people are still living from month to month or week to week with their paychecks.
Yeah, okay, interesting. So if you're saying avoid the cheaper areas, are you talking socioeconomic areas? Are you talking price point entries? Like, what would you?
Well, the two are related, Aaron, aren't they? It's not a judge of people.
Absolutely not. No.
So let me make it clear. But if you can only own so many properties, and we each have our financial limits of what we can afford to buy, then buy the best properties you can, because you were talking at the beginning of the show about this being your cash machine for the future. In other words, when you retire or slow down or do whatever you choose to do. So your future income is going to be dependent upon your tenants' ability, as I said, to keep paying higher rents. So I like choosing socioeconomic areas, not the most expensive areas, not the most expensive suburbs, not the Turex and the double bays, because they're more volatile, but gentrifying middle ring established suburbs where people have got two incomes and growing incomes, because people still want to rent in those locations, Aaron.
Okay, cool. So for people listening, they're like, okay, Sydney, Melbourne, Brisbane, give me an example of where you'd go. Good middle ring cities that are double incomes, highly sought after. Are we talking like an Alexandria, for example, in Sydney, or what? And I hate doing the suburbs.
Well, it's not just suburbs, because it's the right properties in the suburb, Aaron, as well. So we start with a top-down approach. How's the economy going? What's happening? Which states are creating more economic growth? So why is Melbourne not performing as well at the moment? Why are some areas performing better? And it's got to do with local confidence and local economic growth and activity. But if you're an investor, rather than looking for the next hotspot or what's working now, I suggest people look at what's always worked and what's going to work in the future. And that's why we spend a lot of time looking at demographics and demographic changes. And I work closely with Simon Kirstenmacher. I even have a podcast with him, Demographics Decoded, where we look at what's going to happen in the future. So gentrification is one area where more affluent people move in. So in Melbourne, it's the Middle Eastern suburbs, and that sounds scary when I said Middle East because it's nothing to do with that, but the middle ring suburbs, not the affluent Hawthorns and Turex and Kews, but maybe east of Warrigal Road or the southeastern suburbs along the Bayside. Yeah. In Sydney, it's actually similarly that you can go quite some distance out. Look, you're never going to move Parramatta or Penrith to Bondi Beach. Mm-hmm. So an apartment overlooking the water in Bondi is going to still always do well, but I'd be looking at family-friendly apartments in Sydney, not high-rise, the more modern apartments, or the terraces in the inner west, or the middle ring suburbs of Sydney. Brisbane, not as far out. Interestingly, Brisbane apartments have done really well. They've grown about 40 up to 50% in some cases in the last couple of years alone. But I'd rather not buy an apartment in Brisbane. There's a shortage of them at the moment, but Brisbane people still a little bit behind Melbourne and Sydney in apartment lifestyle. So I'd be buying homes in the Brisbane middle ring up to 10, 12 kilometre suburbs, either on the north side or the even south of the river as well.
Thanks very much. Hey, Michael, I appreciate it. And like I said, the question here is not for hotspots. The question is just more frame of reference for people that are listening, going, okay, give me some context what you define as that middle ring area. And like we said, it's not the suburb in itself is never going to be the silver bullet. You got asset selection sitting below that going.
Definitely.
If you buy the right area, you could buy the wrong property, for example. So don't think that the area. I've done a few of these where we've touched on.
So don't pay attention to median prices, Aaron, because median prices for a suburb are not a very good indication. The suburb I'm living in Brighton, in Melbourne, I've got the beach just 2 minutes walk at the end of my street. Across the other side of the main road here, it's no longer the Golden Mile, but there are still expensive houses, but nowhere near as expensive. And then you go even further in the postcode 3186, and you'll still see some lovely old single-fronted or double-fronted weatherboard terraces from 100, 200 years ago. Within the same municipality suburb, there are three different zones, districts with different price brackets. And if people are not selling their upper end properties as they haven't in the last couple of years, it's lowered the median price in this suburb, Brighton, 3186. But that doesn't mean the value of these properties has gone down. It's just you don't need to upgrade your trophy home if the market's a bit quiet.
Yeah, nice. Well said. Well said. You touched on something as well there, which is the election. And I'll give a very quick story. We've got clients all over the world. We've got quite a few clients over in the US at the moment, and it is sitting still going, we're not going to buy back in Australia, the political unrest in America, we're not going to make any decisions. And I said, look, with all due respect, those decisions aren't really going to move the needle too much in the Australian property market. It seems to be fairly resilient, fairly within a bubble in its own self. And we're talking about an election coming through here. And I've been through a few of these in my time in broking, just to go, people put their life and their plans, especially buying, on hold, waiting for a political outcome. And I can't understand it. I'd love for some people to explain it to me rationally. But when you hear that, again, with all your years of experience, how do you get someone out of that mode of going, I'm going to wait and see what happens with the election, and why that's probably not a great idea?
Well, Aaron, I think you're giving your listeners really good advice, because life is going to go on after May or April, whenever the election is. And whatever the outcome, it's not going to change property a lot, but it's not just property. Businesses stop making big investment decisions. Look, unless there's a deal breaker like there was in the 2019 election about capital gains tax, it's unlikely that there's going to be much change. If you have in our economic and our property environment, if you look at it, both parties are coming up with similar policies. Yes, one says I'm getting rid of HECS, the other says I'm going to use super, but in general, it's not going to change things, and trying to time the market is foolish because the experts can't. So I think the first step you've got to understand is what's knowable and what's unknowable, and stop wasting valuable brain space on the unknowable information. It's irrelevant. What's knowable is that well-located property has for over 200 years kept increasing in value, not consistently. There are periods, often up to a decade, in our capital cities where values stagnate or even fall for a while. But if you get to the point where you realise what's unknowable and what's knowable, you'll be amazed at just how much you can ignore. Don't worry about those things. Just like after COVID, I mean, COVID was a reason I understand that. Are we even going to get through this? Are we going to live? Yes, you put your decisions on hold for a little while, but the election, no, I can't see a reason to do that, because if you're in the financial position to get it right, to buy something, to hold on, then just do it. And don't worry. Who wouldn't have liked to buy the house their parents bought at the price the parents paid? But I do remember, Aaron, that in the first 10 years of my investing in the 70s, I didn't know much. I just bought properties. In the 80s, if somebody would have told me that later on that decade there'd be a global financial crisis, if in the 80s they told me, in the early 80s they told me, hey, in 2 years' time, in the early 80s, there's going to be a recession. If they told me the fluctuations in interest rate, how governments were going to change just in the next decade, I wouldn't have bought a property. All these things are just too much to take on board. But I didn't know any of that stuff, and so I was dumb, and I just bought, and those properties have doubled again, and doubled once more. So I think there's a quote a little bit like, the trouble with weather forecasting is it's right too often for us to ignore and wrong too often for us to rely on. Don't try.
Nicely said. Thanks very much. And I hope that's, as you're listening, I hope that's just a little bit of that reassurance to you to go, there have been enough political changes. There's been enough elections in the past to go, hasn't really moved the needle. And if someone's sitting, waiting, hoping, that is probably not a strategy that served too many home buyers or property investors from my experience anyway as well. Michael, as we go through, you said this year's two halves, for example, and I think the biggest conversation piece to come out has been rates cut. February, and then it talks about, hey, how many more rate cuts, if more rate cuts, and then if there are, how many. Now, I'm not looking for a prediction here, but I'm just going,
yes, you are.
From a sentiment perspective, and that's what I really feel, and I think you touched on it very early. The second that we got back in this January, I cannot tell you how many people reached out the first week in Jan, waiting to get in. And I feel like it was sentiment driven. And we've seen this post rate cut, and we're seeing this now for potential future rate cuts as well. People are getting in now, now the groundswell is really starting to get that momentum. We're starting to see some confidence come back into the market. So what does the conversation around future rate cuts look like for yourself and your outlook? And then what does sentiment look like, and how does that translate into buyer behavior?
Okay, so we started talking about macroeconomic factors, demographics and supply and demand and vacancy rates and the economy and jobs and all those. They're important, but they're big picture macro long-term factors, and the micro factors really are the short-term It's all comes down to confidence. And they all sort of relate into that, because if you feel confident about your job and if your wages are going up and if prices around you are going up and auction clearances are going up, you feel more confident. So our markets are driven by confidence. And sometimes it's false confidence, as was 12 months ago when many people thought interest rates were going to fall. So yes, there has been a rate cut, and there's two schools of thought. Fantastic, it's really good. Why didn't you do it earlier? But there's a lot of smart economists who are saying maybe there was a bit of political pressure. Maybe the Reserve Bank shouldn't have done things. Is it interesting? It's an election year. Now, Michelle Bullock came out and said that don't count on 2 or 3 more, 4 more interest rate cuts like the market is suggesting. And is she saying that because she really believes it, or is this just part of the rhetoric to stop people going out, borrowing more, spending more, making the market move? So to be fair, you'd know the figures better than me. 0.25% interest rate cut doesn't change your serviceability a lot. In other words, you can't borrow that much more, and doesn't change your monthly mortgage if you're a typical Aussie battler who's finding it tight at the moment. But what it will change is confidence, that people say, okay, I can now get into the market and I know interest rates aren't going to go up again. I'm not going to get caught out. Or some are anticipating there'll be further cuts, so I'll get in before the crowd does. Again, just like with the elections, don't count on any of those factors to make your investment decision. If it's right for you with your finances and your long-term goals, I'll be making the decision based on that. How many more rate cuts? Well, National Australia Bank say and Westpac say 3. ANZ suggests 2. CBA believe there's going to be 4 this cycle. What's going to happen is interest rates are going to have to drop sufficiently to stop slowing down the economy, but not too much to be stimulatory and drive inflation again. And no one knows exactly where that Goldilocks level is, but it's probably a 0.75% or a 1% drop in interest rates from 3 cash rate that we had, 4.3, whatever it was, before this last drop. And then if APRA come in and loosen their buffers a little bit, that'll increase serviceability. And if one can use superannuation like the National Party are suggesting, or if HECS isn't taken into account for first home buyers like the government is suggesting, all those things are going to give people a little bit more money. In general, though, at the lower end of the market, first home buyers, Aaron, and you know that because you're dealing with them in your mortgage business the whole time, they'll borrow as much as they can. They'll go to the limits. But I think what this is going to do is stabilise the Melbourne and Sydney markets rather than boom them. Melbourne's fallen little by little, 0.1, 0.2 a month for a long time. And I've already got some insights into February. It's going to fall a bit more, as will Sydney in February. Having said that, I think it's going to stabilise it, and it'll take a few more cuts to increase it. But who's going to benefit more, in my mind, are people with multiple mortgages, investors with a lot of properties. That 0.25% multiplied by 3 or 4 makes a difference. But there's also a lot of people who have significant equity in their home, and people are going to, who've been sitting on the sidelines in the more affluent areas, are now going to get on with their lives, upsize, downsize, right size. And I think the bank of mum and dad are going to pull out equity from their homes to help their kids as well. So it's just sentiment that's going to change with these interest rate drops, but probably 2 more over the term of this year, maybe the next one in May. It's just so dependent, not just on inflation. The Reserve Bank looks at inflation, but they also look at employment, and they look at the GDP, the economy, and they actually have to see how our Australian dollar's going compared to overseas. If their interest rates are going up and ours are going down, and it messes up our dollar too, it'll depend upon the price of oil. And maybe the government is going to throw in some bonuses for the election, maybe increase the electricity benefits or other things. So there's too many factors to decide when.
Thanks very much. No, I appreciate the insights. And like I said, it's not about being right here. It's just more like what simmers below the surface when the RBA is making decisions. But like I said, this is a sentiment-driven property market that we're right in at the moment. And I'd say investor sentiment. I saw your numbers. That investor lending is up, right, and from where it's been previously. And it's the potential around rate cuts and easing cash flow, because that's probably the bane of a lot of investors' existence, which is rates are sitting circa 6.5% above for an investment loan, and they're not getting those as yields, but you get that pegged back a little bit with rate and the yield starts to improve, your cash flow starts to improve, and then that confidence, which is, hey, look, I can then strip the equity and go again, yes. Particularly around those refinance buffer rates. I think that becomes crucial for us, and I think from my own experience, every time I've seen changes to lending, that's generally where I see that acceleration in the market, which is now people can borrow more. It brings a lot more confidence back in once people can borrow more and buy more property. And that's when you've got your investor versus your homeowner really going head to head on good quality assets. And that's where you start to see the price really start to nudge upwards. So I've always seen the second we start to either loosen lending, open the door from a lending policy change perspective, is generally see this horse start to bolt with price rises as well. The RBA rate cuts, just the initial start of that.
Yes.
For Rolling Stone gathering some moss as well.
Yes.
Yeah. Cool. There's one that I saw, which is your market, the future 2025 and beyond. And if I'm looking at some of the data that you've put out here, I'm just bringing this up. So you got NAB, which is put out their forecast for the year as well. And then you look across the board, the capital city averages are sitting around 4%. That's for 2025 as a prediction. Then you look at the 3-year predictions, which you've got Oxford Economics, and all this data will include a little chart pack on this data and links to your site as well. But I think it aggregates all these predictions so well, which is why I always turn to it. And then you go by June 2027, so the next 2 to 3 years, everything's positive. You look at every state here, I'm like, everything's got growth.
Well, again, we know the predictions are going to be wrong, and I haven't seen updated ones since the interest rates dropped, but I'm sure they're going to come out. Other than Louis Christopher from SQM Research, who provides really, really good data, but his forecasts, he actually has 5 scenarios. If interest rates go up, if population changes, this or that, he's knocked them all out, and they've actually gone to his baseline where he also believes the property markets are going to pick up. And they will. But I guess we've got to understand that even Melbourne and Sydney and the big capital cities are not just one market. So different segments within those markets are going to perform. Houses, townhouses, apartments, inner city, outer suburbs. The affordable property markets have outperformed the last couple of years because of affordability issues. But now when they've picked up more than the inner and middle ring suburbs have, so that the gap isn't as big, people may just make that leap to get to a better location. And if more affluent, established homeowners and investors come back to the market, as I think they will as the market turns, they're going to be more a flight to quality rather than the outer suburbs. One of my concerns is that there's a lot of new investors coming to Melbourne, currently seeing Melbourne as the new Perth or Brisbane, where Perth and Brisbane were 3 years ago. Perth hadn't gone up for a decade. Melbourne hasn't done a lot. Yeah. And so they're being driven by some probably well-meaning but maybe inexperienced people telling them to go to outer suburbs. I've lived in Melbourne for 70 years and I haven't ever been to these places. I think lifestyle has become more important. So location is a big factor in the driver of capital growth and rental growth. And lifestyle has to do with what's called the third place. Your first place is your home, your second place is where you work. And the third place, which became so more important over COVID, was the ability to go to a gym, to a house of worship, to shopping, to recreation, to parks, easily and quickly. And the outer suburbs often, in general, in fact, don't have the infrastructure for that. So they're not going to gentrify. So I like, if we're looking in the long term, not just have the growth of the market, but a bit of a push by having a suburb that's gentrifying. So I'd be very cautious about where, even in these states that, as you say, are going to perform well, just be careful where you buy.
Yeah, thanks very much. So if someone's coming in and you say, be careful where you're going to buy, what is your advice to, I'd say, an investor that maybe has probably one or two properties under their belt. And, they've got, they've bought well. And so now they're starting to get a little bit of rolling momentum. And it's almost like now this is a stage, and hubris really comes to mind as a word for me, because you've got confidence and now every idea looks like a great idea.
That's interesting, isn't it? Because some people have done very well in the last little while. And so on the basis of that, but hey, that was me 40 years ago. I didn't know all this sort of stuff. I just did well, and I was driven by a property boom. When I first invested, I went halves with my parents. We paid $18,000 for a property, put $1,000 each down, and took a $16,000 for 30 years. I had no idea how I was going to pay that off. But interestingly, Labor came into power, inflation came up, and all of a sudden I looked smarter than I was. So I actually think it's important to have a strategic plan. In other words, know where you are, know where you're heading, and a strategic plan is a lot more than buying a property. Buying a property is not a plan. Property investment is a process and not an event. It takes a long time. And the strategic plan should have a number of components to it. And for most people growing their wealth, like you were saying a minute ago, that client, I believe they need two businesses. They need a cash flow business and a capital growth business, because we don't know what their future is going to be. So they need to, in the future, build as big an asset base as they can in the most flexible way they can, Aaron, because the world's going to change. Interest rates are going to change. Bank lending criteria are going to change. Maybe they're going to be able to use their super. Maybe they can't. So the cash flow business is their income, their profession, their job, their business, if they've got a business, providing the cash flow to build a capital growth business, because residential real estate is a high growth, relatively low yield investment. Perfect. So you need the two together until you build a big enough asset base that you can let the cash flow business go, and then you start living off your property portfolio. So your strategic plan should be talking about how you build your capital growth, how you maximize your rent, how you minimize risks by owning the right structures, by having a smart finance strategist like your team putting together a finance plan that buys them time and not just buffer, not just property, so they can ride the ups and downs. They should have a long-term plan of slowly then lowering their loan to value ratios, and then a way of living off their equity or their properties. And also, to be blunt, you can't just have property only. I think if anyone says property only or shares only, you should run away very quickly, because really I think you need a combination of things to grow wealth. And I think you also need somebody to help you with that plan, external, somebody who can see your blind spots. And this works really well, Aaron. I know you and Bernadette work together as a lovely team. Pam and my wife and I do. But in every team, there are people who one's a little bit more active and the other one isn't. Mm-hmm. So having a plan also helps align life partners, or if you're doing it with family members, so that that's the goal. That's what we're doing. Misaligned expectations can mess you up a little bit. So answer a long-winded way your question, what does this guy who's already got two properties want? Depends where you are on the journey. So what suits you now may not have suited you a couple of years ago when you started, and definitely won't be the right sort of property in 10, 15 years' time when you're at the next level. So really, it all has to fit in with a strategic plan that's customized to your specific circumstances.
Michael, if we wrapped on that point, I reckon it'd be a killer episode, because everything you've said there embodies exactly, to me, what investing in property and a lot of our previous episodes have reiterated. So let me go through this and what you've said. If you listen, I'd suggest go back and re-listen to that part where Michael just kicked off, because we speak about having you've effectively got two businesses. You got your capital growth business, which is your property business. You got your cash flow business, which is your income. And we tell everyone you are your greatest asset. Your ability to earn your income and have an income that increases over time that you can control. That is where you need to put a lot of your energy and focus. And people put a lot of energy and focuses into the property side and lack the ability to focus on pulling the lever on an income side. If you can generate more income yourself, you can buy more assets as well. And assets over time will increase as well. What you've said there also is the strategic plan. And I feel like that's a word that probably gets bandied around a little bit. Break it down into two very simple parts. One is your loan strategy. So what are you doing from a loan and a borrowing perspective? And then what are you doing from a property strategy perspective? What property are you buying that fits your portfolio for the right purpose? So we talk about being fit for purpose. So that property is going to increase in value. You're going to pay it off over time, keep it for retirement. It's going to increase over time, sell it, pay off my mortgage, for example. They're just a couple of examples of how property can fit into your life stage. And I think the most important part you've mentioned there is if you're in life partnership and you're the one driving this, you've got to bring your partner on the journey. Too often we're seeing listeners that are 50, 60, 200 episodes deep, and now they're trying to get their partner to come and play catch up because they've found this great buyer's agent or broker that they've suddenly been listening to. It's like, understand that you've got hours, hundreds of hours up on your partner, expecting to come to the party on where you are. You need to be on this journey together, and you cannot build a house off two different blueprints, especially financially. And I think that's probably where Bernie and I, speaking purely from experience, that's where we've got the greatest alignment, is when we're knowing exactly what we're doing, why we're doing it, and who we're doing it with financially. I think that's probably given us clarity and confidence about how to move forward as well. So, Michael, I think you've absolutely nailed it on that point.
One thing I left out, Aaron, risk management. The plan has to have a risk management plan as well. And that starts off with insurance. You said it yourself. You are your biggest asset. When I ask clients, what's your biggest asset? They'll say, my wife, because they think that's the right answer. and then they'll say, my home or my property. And I say, no, it's your borrowing capacity, your earning capacity for the next 30 years, 20 years. If you're earning $200,000 a year, that's $4 million income. How much of it have you actually kept so far? And what are you going to keep in the future? And what happens if it disappeared? So risk management is in personal risk, ownership structure risk, diversification risk, and tax minimisation, safe, not cheating risk as well. So risk management is something I should have mentioned.
Mate, nailed it. And literally, we have gone through this. Again, I'm not going to tell someone to do it without done it ourselves. In the last 3 to 6 months, I've updated our wills estate plan. We have got reinsurance across key person risk in the business. All our insurances on our properties updated as well. Our life insurances have recently involved even for us taking blood tests, health tests, for example, for our life insurance, because we're insured for a certain dollar value, and it's going, right, these are all new challenges that we didn't have 5 years ago. 2 small kids, extra debts, running the business, for example. And it's an evolution that as your life and sophistication probably starts to increase, you need those insurances to start reflecting your level of sophistication and debt that you have as well. And it's probably a really good reminder that something that maybe we cover off in a future episode, to actually talk about risk management as your portfolio and your income starts to increase, which I think is super, super pertinent.
If I could explain what I used to do, I'm too old to be insurable now. But every time I bought a property, I used to increase my personal insurance. Sorry, this is not advice. I'm not allowed to give advice on this. But the answer is I used to increase my insurance so that if I died, unfortunately I didn't, my wife would have been able to pay off all the debts. So I increased it to the level of the debts so I could pay off all the debts, so she would have had the properties to look after the kids without the debt. So you're right. It's not a set and forget. And that's part of the strategic plan, to annually review clients. And that's where I think we've taken our business to the next level by not even talking about property. Everyone comes and says, what suburb, what budget? No, we do the strategic plan first.
Well said. And you cannot drive your car without car insurance. CTP, it's called compulsory third party. You need it to drive your car. You need to have your car insured, for example. And so often people are with their greatest assets that are far more valuable than cars. If you listen to me, if you're listening to this episode and you live in Australia, you are more valuable than the car that you drive. The car depreciates in value, you appreciate in value, and too often people insure their cars over themselves. I think that's one of the biggest tragedies I see for a lot of people. Just going, I can't believe you value your car more importantly than you do yourself. Beautiful. Hey, Michael, if you were to kind of wrap up on a point for a lot of people that are, obviously they turn into you, they turn to ourselves for some property investment insights and a little bit of, I won't say motivation, but a little bit of guidance. What's kind of your last point to wrap up on to give someone that reassurance and that confidence to keep going, given that you've been in the game for 50 plus years?
I think before I give them confidence, I also want to point out that most property investors are going to get it wrong. They do. They always have. They 50% sell up in the first 5 years, according to CoreLogic, and those who stay in the market, tax department figures show that 92% never get past their first or second property. So I guess the advice is don't do what everyone else does. Otherwise, you're going to end up with the same results that they do. But those who get it right are going to do very, very well because they always have. So that follows on what we've been talking about for the last half an hour, Aaron. Yeah. Have a plan, get good advisors, be prepared to pay for advice, get independent advice from somebody who doesn't have a property to sell or isn't bound to a specific market, but because most investors get their information for free from the internet, and that's the most expensive advice. All the wealthy clients I know have mentors, have business coaches, are prepared to pay for their advice. And I believe we're at the next phase, the beginning of the next phase of a property cycle. In other words, in Perth, this started 4 years ago, much like it did in Brisbane. In Melbourne, it's only going to start now. But the lower interest rates and the confidence that's going to bring and the extra serviceability it's going to bring is going to push the markets up. But each upturn sets itself up for the next downturn, just like every downturn sets itself up for the next upturn. So it's not going to keep going up forever. Own the best assets you can and buy yourself flexibility and time by owning the right assets in the right structures. And property investment's a game of finance with some houses thrown in the middle. So get somebody good on your side, like the team at Atelier Wealth, to get you the right finance in place. And that's going to save you the worry and stresses when the world turns around, as it always does.
Beautiful. Michael, I want to say thank you very much. Like I said at the very start, highly respected in this space. Strong track record as well. But I think the most important part is the generosity that comes with your knowledge, your insights, for example. Again, you're doing your podcast. You bring on some incredible guests on there as well. Dr. Andrew Wilson, for example. You get some really good, Tim Lawless as well. So going straight to the source of truth for a lot of data, a lot of insight. So I'm happy to kind of share for listeners to go, hey, look, if you want to listen to another great podcast, that's an awesome one to plug into too, because I will check it out from time to time. So, Michael, I want to say thank you very much for joining us. If you're listening, just a couple of little reminders. One is we're kicking off our community event. I believe it's on the 12th of February. So if you're looking to be part of a plugged-in community of elite investors that want to champion each other's success, celebrate the journey that you're on, and just be around a high quality caliber investment community, investment property community, then drop the word community into our DMs or send us a message as well. And we'll include the details to come along to that first call. If you're looking for getting started on your journey and you want to get the roadmap, pretty much what Michael said, like the property strategy, reach out to us as well. We'll get that going in terms of where you can start and what those next steps look like. Or if you've got a existing property portfolio and you want a portfolio review, then just DM us portfolio review, and then we'll organize a session where you can talk to one of our brokers and go, right, where am I at? What does my equity look like? What does my borrowing capacity look like? And how do we start to add strategic assets into the mix as well? So that's a wrap for another episode of the Australian Property Investment Podcast. Thanks for tuning in. We'll talk soon.
Well, I thought that was a great chat with Aaron Christie-David. I hope you did as well. And I'll be interviewing him in a couple of weeks on my podcast. But before I give you my popular mindset message, and by the way, thanks for all the emails I get with people saying that they really enjoy that mindset message at the end of each show, I want to teach you about the law of diminishing intent. And the law of diminishing intent says the longer you wait to do something you know you should do, the greater the odds are you're never going to actually do that. Now, I'm going to talk a bit about Wealth Retreat, but I'm not just talking about that. Wealth Retreat's a shortcut, a proven means to an end. I'm talking about investing time to set clear and compelling goals based on your personal purpose, your priorities, and your potential. If you know getting goals and plans in place is something you should do, then my suggestion is don't put it off another minute. Grab your calendar, block the time, and commit yourself to the task. Of course, if you need help finding the right time, the right place, the right mindset, the right materials, it's all waiting for you in a turnkey package at Wealth Retreat on the Gold Coast at the beginning of May. So I suggest you go to wealthretreat.com.au and express your interest and reserve your early bird spot. There's a couple of early bird spots left. Look, you've heard about Wealth Retreat in previous podcasts. You're probably getting emails from me about it. But it's been said that most people spend more time planning their vacation than designing a fulfilling life. I don't know whether it's because of procrastination, the tyranny of the urgency, or no clue about how to even set meaningful goals. But you can conquer all three with one great decision: to get away from the daily grind for a powerful 5-day training where you're going to have effective goal setting, networking. You're going to suddenly develop a peer group of people, like-minded people, and masterminding. And the aim of Wealth Retreat is to design the next 5 years of your life, not only in property, but holistically. So you're going to arrive on Friday night with ideas and dreams and walk out on Wednesday with goals, plans, and a toolbox full of tools to redefine all areas of your life, not just property, not just finance, but health, relationships, contributions, spirituality, and more, because true wealth is much more than just property. Now, if those 5 days make you, 1% more focused, fired up and effective this year, what would that be worth to you? And what if you finished the next 5 years, which is the theme of Wealth Retreat, up 10%? What would that be worth to you? So my recommendation to you is, since you're always your best investment, you are your best investment, and that all starts with a clear vision, defined goals, and a motivating plan, make it happen. Go to wealthretreat.com.au, find out about it, register your interest. If you really want to join, I'll have a chat with you and we'll have a talk about whether you'd benefit. And if I believe you will, I'll back Wealth Retreat with my money back guarantee. wealthretreat.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to ask you a question. If you had 1 day left in your life, what would you most want to do? Too many people live a life according to a script they didn't even write, only to discover the punchline too late. I wish I had the courage to be my true self is one of the biggest regrets people apparently have when they're dying. The other main regrets are, I wish I'd never worked so hard. I wish I'd had the courage to express my feelings. Other regrets they have when they die, I wish I'd let myself be happier, or I wish I'd stayed in touch with my friends. You see, I found we're often trapped working on other people's to-do lists, so much so that we never stop to connect with our soul and ask, what is it that we can't wait to do? Chasing dreams can feel intimidating, but nothing is as dreadful as living a life of regret. I see people all the time sacrificing their health for wealth. They tend to spend their wealth trying to regain their health then later on. Crazy, isn't it? So from now on, stop keeping score of the digits in your bank account and start chasing invaluable experiences and start making an impact. You're the author, the director, the hero of your story. At any moment, you've got the power to reprioritize and reinvent yourself. It's never too late. In fact, you'll never have more time than you have right now. Just think about that. You'll never have more time than you have right now to start enjoying your life. So live every day like it could be your last, because one day you'll be right. So my message to you today is, if today was your final day, what would you most want to do? Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour. And you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favorite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?